Good afternoon. Today our topics accounting ratio, third part activity ratio. Activity ratio, others names performance ratio or turnover ratio. Turnover ratio, this ratio indicates how efficiently and profitably the total capital, working capital, fixed assets and inventory of the business are used. This ratio measures the efficiency and rapidly of the resources of the company. Now, some of the important ratio are as follows: activity ratio or turnover ratio or performance ratio. This ratio may be divided into their four parts. First part, inventory turnover ratio. Second, debtors turnover ratio. Third, creditors turnover ratio. And fourth, working capital turnover ratio. Okay. Now discuss one by one. First, inventory turnover ratio. What is the meaning of inventory or stock? Stock turnover ratio, it is the relationship between cost of revenue from operation and average inventory. Average inventory equal to opening inventory plus closing inventory by 2, and cost of revenue from operation, cost of revenue, you are just find out, this is the rules. Cost of revenue equal to find out from two sides. One is the net revenue from operation minus GP, that means gross profit. Okay, and another also cost of revenue from operation equal to from class 11 trading account, that is the cost of revenue from operation equal to opening inventory plus purchase plus carriage inward plus wages plus other direct expenses minus closing inventory. Okay, that is known as cost of revenue from operation. Now, what is the importance? Now, this ratio indicates whether inventory has been efficiently used or not. The higher the ratio, always the better it is. That means it indicates that inventory is selling quickly. In a business where inventory turnover ratio is high, that means goods can be sold at a low margin of profit, and even then the profitability may be quite high. But in the case of opposite, their low inventory turnover ratio indicates that inventory does not sell quickly and remains laying in the godown for quite a long time. The result is increased storage cost, and also they are hamper in their capital also. That means this ratio always indicate that there is no rule of thumb for interpreting the ratio, but higher the ratio better always. Okay, it measures the velocity of conversion of stock into sales. Higher ratio indicates efficient management and low ratio show inefficient management. Okay, that is the inventory turnover ratio. Point number 2, debtors turnover ratio or DTR short form. Debtors turnover ratio may be calculated the following formula: net credit revenue from operation divided by average trade receivable. Okay. Now, what is the meaning of their net credit revenue? The net credit revenue equal to the total revenue minus cash revenue from operations, and average trade receivable equal to opening receivable plus closing receivable by 2 average. Okay. Now, this ratio, what are the importance or significance? This ratio indicates the speed with which the amount is collected from trade receivable. The higher the ratio is, better it is, since it indicates that amount from trade receivable is being collected more quickly. Okay. Now, it depends upon the policy of the management and nature of industry. Now, this is the trade receivable turnover ratio. It indicates the number of times debtors are turned over during the year. And another also there are sub parts, average collection period. Now, average collection period, this is the average collection period equal to 365 days or 12 months divided by DTR, short form. That is the, or another formula, 365 or 12 months divided by trade receivable turnover ratio. This is the important. This show the average amount of the days for converting debtors into cash. Low average collection period is always favorable for the business. Okay. Now, next point number 3, creditors turnover ratio. Creditors turnover ratio, or another's name trade payable turnover ratio. This ratio indicates the relationship between credit purchase and average trade payable during the year. How to calculate? This is the net credit purchase divided by average trade payable. Now, average trade payable, that means equal to average creditors plus average bills payable also. This ratio, what are the importance or significance? This ratio indicates the speed with which the amount is being paid to trade payables. Higher the ratio, the better it is, since it will indicate that the trade payable are being paid more quickly, which increases the credit worthiness of the business. Okay. Now, again also their average payment period, same also in this case, 365 divided by trade payable turnover ratio or creditors turnover ratio, or 12 months divided by trade payable turnover ratio. Okay. Now, last part, that is known as working capital turnover ratio. Point number D, working capital turnover ratio, short form WCTR. That means it is the relationship between revenue, net revenue from operation and working capital. Okay, working capital you are known, that is equal to CA minus CL, working capital. This ratio of a particular importance is non-manufacturing concern, where current assets play a major role in gathering revenue from operation. This ratio reveals how efficiently working capital has been utilized in making revenue from operations. Higher working capital turnover ratio show efficient use of working capital, and low working capital turnover ratio indicates underutilizations of working capital. Okay, this is the theory portions of activity ratio or turnover ratio.